Hey traders, in this video I am going to reveal the top fake candlestick signals that you must absolutely avoid if you want to protect your trading account. I'm sure you've experienced this before, where you spot a perfect-looking candlestick pattern, like a pin bar or an engulfing candle. You enter the trade, but the price immediately reverses and hits your stop loss. This happens because you were falling for fake candlestick signals, and in this video, I will show you how to identify these traps so you can keep yourself on the winning side of the market. The first fake signal you must avoid is what I call the isolated pin bar. A pin bar is a highly popular single candlestick pattern characterized by having a relatively small body and a very long wick or tail sticking out on one side. It is widely used to predict market reversals because the long tail shows a strong rejection of price. However, the biggest mistake beginners make is focusing entirely on the color of the pin bar or trading it in the middle of nowhere. First of all, the color of a pin bar does not determine if it is bullish or bearish. A bullish pin bar can be red or green, and a bearish pin bar can be green or red. What matters is the position of the tail, which shows where the rejection came from. But even if you identify the correct pin bar, trading it by itself is a low-quality setup. A single candlestick pattern alone does not have enough strength to reverse the market. To turn this into a high-quality setup, the pin bar must form at a major key level of confluence, such as a strong support or resistance zone, where there are other supporting factors at play. If you see a pin bar forming in the middle of a trend with no key levels nearby, it is a fake signal, and you must ignore it. The second fake signal is the forced igniting bar in a three-bar pattern. The three-bar pattern is an incredibly powerful beginner strategy that consists of three consecutive candles, an igniting bar, a pullback bar, and a confirmation bar. The igniting bar is the most important because its large body proves that high institutional liquidity is present. However, a major mistake traders make is trying to force an igniting bar when it is simply not there. If the candle body is relatively similar in size to the previous candles on your chart, then it is not a valid igniting bar. An igniting bar must be significantly larger than the surrounding candles to show true momentum. Furthermore, you must avoid trading a three-bar pattern if it forms immediately after a very sharp vertical price movement. Quick, sharp movements are generally unsustainable and will result in a deep pullback that will stop you out. Instead, you want to see the pattern form within a gradual, clean trend, which is much more sustainable. The third fake signal to watch out for is the giant breakout candle. Breakout candlestick patterns occur when multiple small consolidation candles are followed by a large breakout candle that closes outside the range. While a breakout candle shows strong momentum, a common trap is entering the trade when the breakout candle is 3 or 4 times larger than the average candle on your chart. When a candle is this massive, it means the entire move has already played out and the momentum is completely exhausted. Chasing a giant breakout candle is highly dangerous because the price is very likely to reverse immediately and trigger your stop loss. If the breakout candle is way too big, the setup is invalidated and you should stay out. The fourth and final trap is the Heikin-Ashi color trap. The Heikin-Ashi is a popular trend indicator that fully replaces a traditional candlestick chart to smooth out price action and filter out market noise. It makes a trend look incredibly clean because all the candles remain the same color during a move. However, the absolute fastest way to blow up your account is blindly buying when you see a green Heikin-Ashi candle and selling when you see a red one. You must understand that Heikin-Ashi uses a special averaging formula and does not show the actual market price. If you treat Heikin-Ashi like a regular candlestick chart, you will end up entering trades at terrible prices and taking massive losses. To trade it safely, you should always use a side-by-side chart view or an indicator that shows both the Heikin-Ashi candles and the real candlestick price at the exact same time. This ensures you can confirm the clean trend without losing track of where the real price actually is. Mastering these candlestick patterns is all about filtering out the fake moves and waiting for the highest probability setups. If you found this video helpful, kindly do me a small favor by hitting the like and subscribe button. It only takes 2 clicks, but it means so much to me and helps the channel out a ton. Also, make sure to join my free Telegram community using the link in the description below. Inside, I share my daily market analysis and trade setups completely for free, along with my free candlestick pattern guide. Thank you guys so much for watching, and I will see you in the next video.